Dear viewers and listeners, today I have the pleasure to welcome our special guest to the InvestPRO conference, who, as you'll see in a second, has a mind-boggling theoretical and practical expertise on the topic of inflation we'll be discussing today. So our guest is a professor of applied economics and founder of the Johns Hopkins Institute for Applied Economics, Global Health and the Study of Business Enterprise. He's also a senior fellow and director of the Troubled Currencies Project at the Cato Institute, a contributor at National Review, a well-known currency reformer, and a currency and commodity trader. He served on President Reagan's Council of Economic Advisors, has been an advisor to 5 foreign heads of state, including the Bulgarian Prime Minister Peter Stoyanov, and 5 foreign cabinet ministers, and held a cabinet-level rank in both Lithuania and Montenegro. He's been awarded 7 honorary doctorate degrees, and is an honorary professor at 4 foreign institutions. He was the president of Toronto Trust Argentina in Buenos Aires in 1995, when it was the world's best performing mutual fund. Currently, he serves as chairman of the supervisory board of Advanced Metallurgical Group in Amsterdam. In 1998, he was named one of the 25 most influential people in the world by World Trade magazine. In 2020, Professor Hanke was named a Knight of the Order of the Flag. So after this thorough and detailed introduction, and without further ado, let's welcome Professor Steve Hanke. Professor, welcome to the InvestPRO conference. We are glad to have you today.
Well, Miroslav, I'm delighted to be at the conference. I only wish I was there in person in Sofia, one of Mrs. Hänke and my own favorite cities. Besides Paris, Sofia's maybe 2 or 3.
It's good to be compared to Paris, Professor. So for a quick start, you have plenty of expertise on the topic of inflation. I might say that you're among the very few people in the world who have seen many and different inflation crises firsthand. And you also have plenty of trading experience with commodities and currencies. Do you mind sharing more about yourself so that our viewers can get a better feeling of the mountain of practical knowledge and expertise that you are?
Well, let me briefly do this because it's a long story. I've actually been trading, Miroslav, for 68 years. I started trading with my grandfather when I was 10 years of age. We were agricultural people in Iowa, the state of Iowa, great, as they call it, the tall corn state, right in the middle of the United States. And my grandfather had a big egg business where they would collect eggs and grade eggs and candle them and put them in cold storage until they got enough for big shipments to go back east to New York City or Boston. And in the time span between collecting the eggs, sorting the eggs, storing the eggs in cold storage, of course, that took, it could take a month or so. The eggs would be in cold storage. And in that month, of course, the price of eggs could be going all over the place. So what we would do is sometimes, if my grandfather didn't want to take the risk of the price volatility, he would sell the eggs forward on the futures market in Chicago, the Chicago Mercantile Exchange. And I helped him do that. He taught me how to do it. I was about 10 then. So I've been trading agricultural commodities for a long time. So my summary will be very brief, and I'll try to do it in such a way that I make a couple of principles, kind of illuminate them for your audience and viewers and my friends in Bulgaria. One thing that people in stock markets have to realize that the mechanisms that are involved in the stock market are really the mechanisms for trading money from the impatient to the patient, or from the unwise to the wise. Now, the principle there is you have to be very patient. And if you get excited and go quickly by instinct, you're going to get in lots of trouble. And so that's one thing I want to stress. The second thing I want to stress is something my grandfather did teach me, which is an old Midwestern in the United States phrase, and that is rule number 1 in trading: don't lose money. Rule number 2, remember rule number 1. So that's the basis for kind of my thinking. Be very patient and obviously try to avoid losing money. My big involvement that's notable, and I mention this because, of course, no one in Bulgaria, they all, I suppose, even if they know who I am, they would be thinking of me as someone who is involved as Stoyanov's advisor, installation of the currency board in Bulgaria, stopping the hyperinflation. That was a long time ago. That was 1997, by the way. And speaking of inflation, the inflation rate in February of 1997 was 242% in Bulgaria. So it's only one of 62 episodes of hyperinflation in world history is in Bulgaria. So Bulgaria is kind of a rare bird, and we crushed the inflation with the currency board. So back to trading and my experience, let me recount three activities, shall we say, that were very important. One of these was after the Chicago boys took over and started advising General Pinochet. He was the president of Chile, as you'll remember. He came in 1973, but it was the late 70s, early 80s that a group of us established a fund in Chile. And in fact, in 1981, Chile established private Social Security funds. And our group was the first group to manage these funds. Now, I mention this because the performance of the fund, of course, was quite good. We had the record for Latin America for like 5 years in a row. I mean, each year, we're talking about rates of return over 100% a year. So it was very spectacular. The point here is, by the way, that you have to be patient and wait until you see a situation where the economy is going to go through big structural changes. And in short, liberalizing the economy, introducing more efficient allocation of capital, and there'll be tremendous opportunities that are thrown up by those reforms. So the Chicago boys in Chile, that was case number one. Now, case number two followed right behind that, and that is in 1984 in New Zealand, a Labour Party was elected. David Lange was the prime minister, and more importantly, the finance minister was a good friend of mine, Sir Roger Douglas. And you can look up in Wikipedia what Rogernomics, they call it. And that was a huge liberalization. New Zealand had been governed by a conservative government for decades. They'd almost ruined the economy. It was a very closed economy, no free trade or anything like that. Well, Sir Roger opened the thing up, very liberal reforms, and we set up a fund in Auckland, New Zealand, and that fund also took advantage of waiting patiently for a big opportunity and jumping in on it. And we were trading the currency. The New Zealand dollar got very strong, and we were also trading bonds in that exercise. Then in the 1990s, again, the patience principle and looking for these opportunities, we established a fund in Argentina, Toronto Trust Argentina in Buenos Aires. I was the president of that. And in 1995, that was the best performing fund in the world. So those are three big highlights of big funds, big returns, but they took patience, and you had to anticipate and have a theory behind the whole thing. And the theory was, if you go through radical liberalizations, you are going to get much better allocation of capital and very high rates of return on capital. And of course, that's exactly what happened in those cases. So with that, that's enough, I think, introduction. The main point, as I say, don't lose money, rule number one, and rule number two, don't forget rule number one. So that's where we're going.
Yeah. May you allow me to summarize, because I relate a lot to this as a surfer. What you're basically saying is be patient enough for a big wave, for a big structural wave to come, so you can ride it and take advantage of everything that it can offer, but be always prepared to cut the downside so you don't lose money. Is this what you're saying?
And some of these things, Miroslav, the biggest wave of all, I missed. And that was what? The biggest wave in the history of man is China. Deng Deng's 1979 speech. And the reason I knew it would be fabulous, but I was not knowledgeable about China, and I had no connections in China. And that wasn't the case. I had a lot of knowledge of New Zealand, and I had very good connections there. Chile, we had extremely good connections and a lot of knowledge about it. And the same thing in Argentina, where I was actually advising President Menem and knew Argentina extremely well. So that's, you have to know what the territory. You be able to see the wave and know if you can get up on the board and stay up there.
Yeah. And speaking about waves, what waves, what financial waves, big structural changes you see that are happening right now across the globe? We see inflation rising, commodity prices soaring, energy crisis in Europe. What's your take on that?
Well, most of the waves are the kinds of things that knock you off the board unless you're short. So a lot of short positions will be thrown up, I think, in this transition, for example, to the green economy, and there'll also be a lot of positive things, which we'll talk about that a little bit later. The opportunities, for example, one thing that I'm very long on are anything connected to lithium, because you need lithium for batteries, and if you're going green, you need lots of lithium. And if you look ahead at the projections, there'll be huge deficiencies of lithium. So you want to be in the lithium game. If you look, just speaking of lithium, we might get into this a little bit later, but if you look at lithium, the price of lithium carbonate is, the average price has been $18,000 per metric ton over the course of this year, 2021. The price now is $36,000 per metric ton. That's over double. The price now is over double what the average has been for the whole year. If you look at lithium spodumene, that is more than doubled. It's gone up 2.6 times relative to its average price. So lithium is when you speak of commodities, I want to be long commodities, and I want to be long, in particular, lithium, because not only it's a commodity, but it's one that's very necessary for batteries, which will be in very high demand as we go in this transition to a more green, CO2 efficient world that the politicians are going to drive us in. Whether we want to go there or not, we're going to have all kinds of legislation. You're getting it in Europe right now, as well as the United States. So, and that relates to inflation. You mentioned inflation, Miroslav, and if you have inflation, you want to be long commodities. So long commodities in general, but again, we might talk about that in more detail, but this transition, there is a big, you ask about the structural change. What is the big structural change that's coming? The big structural change is that we're going green, whether we want to or not. That is a structural change. I think there'll be lots of short opportunities selling things, but also there'll be a few long positions that I want to be in. And lithium is a major one I'm focusing on. Vanadium is another one. These are kind of exotic things, but it's where I am. I mean, you ask me what I'm doing, I'm telling you.
Of course. What do you think? I think we can go deeper into the commodities later on. What I want to get your opinion on right now is what do you think about the current state of inflation in the U.S. and in the global economy? Is this a permanent inflation already, or is it more of a transitory supply shock driven one?
Well, this is of course the big debate they call, team transitory in the United States. Team transitory says, all of this is just due to supply chain problems, COVID problems, all kinds of what John Greenwood and I have been analyzing this. So everything I say about inflation, I'm working with Greenwood on it. And Greenwood is that the chief economist at Invesco in London. As you know, that's an outfit that's managing $1.6 trillion in assets. So it's a big operation. And John and I have been very close to each other for many years because this is relevant for Bulgaria. John Greenwood is the architect of the Hong Kong Currency Board that was established in 1983. So that was established in 1983, and I'm the architect of 4 currency boards that have followed that. One in Estonia in 92, one in Lithuania in 94, and then we had Bulgaria and Bosnia-Herzegovina in 1997. So all the modern currency boards have either been done by Greenwood or me. So that's one reason we're close. The other reason we're close is the fact that, excuse me, I had an interruption. Somebody was calling me, pardon me. The other reason we're close is that we were both very close to Milton Friedman, who's the dean of monetary economics, and we're monetarists. So we're looking at monetary policy very carefully, and that is important for investors. And let me give you the main reason why it's important for investors, and then I'll come, Miroslav, to your precise question. If you increase the money supply too rapidly and you have excess money in the system, what happens after that excess surge occurs is that with a lag of about 1 to 9 months, asset prices go up. That means like equity prices go up, land prices go up, real estate goes up, commodities start going up. Then the next phase is that the real economy starts getting hot and revving up. And that comes with a lag of about 6 to 18 months. And then the last thing that comes is inflation. And that is with a lag of about 12 to 24 months. So in the United States, we had the surge in the money supply starting in March of 2020. Huge, massive surge. The money supply has increased by 37% since COVID started in March of 2020 in the United States. 37% total increase in the money supply, massive increase of the money supply. Now, about 75% of that increase is excess money. Now, let me give you a little visual of this. Greenwood and I have what we call a monetary bathtub. And so the money goes in. The money supply goes in the bathtub through the faucet. And then there are 2 drains going out of the bathtub. One drain is money going out to accommodate real economic activity. That's the real growth potential in the economy. The other drain is to accommodate increases in the demand for money. So if those 2 take 25% of the increase that we've had in the money supply has gone out those 2 drains, that leaves 75% in the tub. And where does that go? That goes out what we call the inflation overflow valve. And that starts coming out after about 12 to 24 months. So we're at about that. We've been at, 19 months now as we speak today. We're speaking, by the way, just for your viewers, we're taping this in December of 2021. So your conference won't be until 2022, but we're very late December. It's almost Christmas today. So at any rate, that sequence is critical for investors. If investors don't understand the monetary economics, what we call the quantity theory of money, and the equation of exchange. The equation of exchange, by the way, is MV equals PY. M is the money supply, V is its velocity. That's equal to P, the price index, times Y, the potential real growth in the economy. Now that's an identity, so it must be true by definition. And when you look at that, and look at what I just told you about the bathtub in the United States, we get to inflation, Miroslav. And inflation will not be caused by and is not caused by changes in COVID problems, changes in problems with the Port of Los Angeles, changes in the supply chain with semiconductors and things like that. These temporary things are irrelevant. The only thing that causes inflation is changes in the money supply and excess surges in the money supply. So if you look at that, Greenwood and I wrote an article in the Wall Street Journal in July, and we said that by the end of 2021, we're almost there, and we have November inflation numbers for the United States, 6.8% inflation. And Greenwood and I said in July that the year-end inflation would be 6% or maybe as high as 9%. Now, we did that by just plugging in the numbers and properly calculating the equation of exchange, MV equals PY. If you just do the arithmetic, you can figure these things out. And it must be true, by the way. It must be true. So this inflation will be with us, and a big problem in the United States through, already we know, into 2024. We will see these rates of inflation of 6 to 9%, 2022, 2023, into 2024, because we already know what's in the bathtub. No matter what the Fed does, the central bank, the money's excess and it's in the bathtub, and it will come out the inflation overflow valve. So that's where we're going with inflation. And that means it's persistent. It's not temporary. If you want to read, by the way, nonsense about the team transitory and so forth, the biggest proponent of this is a Nobel Prize winner, Paul Krugman, who writes in the New York Times and is very influential, but he's totally wrong. His weekend article that I'm just looking at in front of me, December 19, Sunday edition of the New York Times, The Year of Inflation Infamy by Professor Paul Krugman. It is all rubbish and nonsense. He's talking about transitory, and he's giving what? He's giving one ad hoc explanation for inflation since World War II in the United States. So he gives all these episodes of inflation in the United States, but there are all these what Greenwood and I call ad hoc explanations for changes in relative prices, not changes in inflation. There's no unifying theme in Krugman's argument. The unifying theme has to be money and the money supply, and it's absent. It's not there. As Milton Friedman taught us, inflation is always and everywhere a monetary phenomenon. It's always caused by changes in the money supply. So that's the guiding principle that should be guiding everybody investing. Should learn this and put it to good use as they invest. I've given you those lags. If you look at the global economy, Miroslav, you asked me about the global thing. I gave you where we were for the United States. That we have a very elevated excess supply of money in the bathtub. Another country that has an elevated supply is Israel, and Israel will probably, in the next 2 or 3 years, see inflation between about 5 and 7%. Another one that has pretty elevated levels is the United Kingdom, and they're going to see inflation around 3.5%, maybe 4%. Then you get down to countries with kind of moderate excesses in the bathtub, nothing super excess, but kind of moderate. And you've got Australia, the Eurozone, and Canada, and the Eurozone, which is of course important for Bulgaria, around 3%. It's important for Bulgaria because the currency board, you've got a fixed exchange rate with the euro, and the lev is just a clone of the euro. So you'll have inflation of around 3%, maybe a touch higher for the next year or two, certainly the next year in Bulgaria. And then we drop down to countries with little excess in the bathtub: New Zealand, Japan, Switzerland, and China. China has virtually nothing in the bathtub. They're very, very orthodox monetary policy. The same with Switzerland. Not much for Japan. You're not going to see inflation much above 1% in Japan. New Zealand, maybe it'll get up to 1.5%, something like that. So that's the picture for inflation. If you look at the global economy, you want to look at real growth in the economy, or do you want me to stop?
Now, I just wanted to ask you, till when do you think this high inflation will continue surging? Will we see another 70s inflation period, like reaching numbers like 12%? Or do you expect that this inflation will start decreasing in the years to come, say 24, 25, let's say a couple of years from now? What's your take on that?
Well, let's just isolate the United States, because when we talk about, you're talking about stagflation, where you have slow economic growth and high inflation. We had that in the late 70s in the United States. So let's keep it simple, Miroslav, and talk about the United States. The numbers that I gave you for the bathtub, the Greenwood-Hankey bathtub, assume that the current rate of monetary growth that's now for broad money, M sub 2, it's a little over 12% per year. We assume that the Fed will take that rate down to a level that would be consistent with an inflation target of 2%. That means they take the growth rate in half. They cut it from about 12. Right now, it's at 12. They cut it to 6. We assume they do that right away. Then we will have persistent inflation of 6 to 9% for 2 or 3 years, and then inflation will settle down. So that's the scenario I gave you originally. But let's assume they don't bring the monetary growth down to 6%. They leave it at 12%. Well, then we could very easily get into something called stagflation. And we could do that because the Biden administration, to get stagflation, you have to have problems in the supply side of the economy. And you get problems when you get government intervention and too much regulation. So that's what they're doing now. They're interfering with the supply side. So that is happening. So in the combination of the Fed continuing to grow the money supply excessively at 12%, and these new regulations and so forth, you could get stagflation in 2024 and beyond. That's possible. You also could get, by the way, something that resembles stagflation, but the scenario would be a little bit different. Let's assume that the Federal Reserve panics and they start increasing the interest rate too rapidly, shrinking the money supply too rapidly. We could have a recession in 2020, late 2022, 2023, whenever they did that. So that's a possibility too. So we don't know exactly what they'll do. My best case scenario is the one that I gave you, where they taper, they slow the money growth down to about 6%, consistent with a 2% inflation target. They do that right away. And then we will only have an inflation problem that will be persistent up until early 2024. That's a best case scenario. So as you can see, it's complicated. You have to keep your eye on the ball and watch what they're doing. But the only way you can keep your eye on the ball is to apply and know how to use a quantity theory of money, because that's what drives nominal GDP growth. MV equals PY is a theory of everything, because it is a theory for nominal national income determination, and nominal GDP growth is split into real GDP growth and inflation. And real GDP, you don't change that too much. So the residual that's left in the nominal GDP it's all inflation. So inflation is the biggest part of the picture for nominal GDP right now, anyway. Yeah, we can talk about Europe if you want to.
Yes. That's what I wanted to shift our conversation to. When we talk about inflation, a lot of people in Bulgaria are asking the question, what currency to put my savings in, whether it would be euro or it should be dollar, because we've seen this year that regardless of the inflation in the US, the dollar gains strength over the euro. What's your take? Will this strength continue? Will the euro regain some strength to the dollar in the mid or near term?
Well, let me tell you let me tell you why the dollar is so strong versus the euro, and then your audience can make up their mind about where they're going to put their where they're going to put their money. They should probably be putting it in Swiss francs, by the way, or even the Chinese yuan is stronger than the U.S. dollar. But the thing is, the U.S. dollar is king. There's no question about that. The U.S. dollar just dominates everything. But it's strong against the euro, and this is an important thing because the dollar-euro exchange rate is the most important price in the world, actually. If you just look at one price, which is the most important one, it's the dollar-euro rate, or maybe dollar gold would be up there at number 2. But why is the dollar so strong? Well, the dollar is strong because there are two ways to perform what we call quantitative easing. That's these big surges in the money supply that we've had. And as it turns out, the quantitative easing in the United States is completely different than quantitative easing in either Europe or Japan. If you look at quantitative easing in the United States and the United Kingdom, they're done in the following way. They've been done in the following way. They've been done correctly, by the way. And when I say correctly, quantitative easing in the United States and the United Kingdom, it does cause a surge in the money supply. So I don't mean their policies have been exactly correct. But if you want the money supply to grow, you have to do it, quantitative easing, the way they do it in the United States and the United Kingdom. Now, how is that? The central banks, either the Bank of England or the Federal Reserve, they purchase securities, government securities, from the non-bank private sector. And when they do that, what happens? The Fed buys bonds from the non-bank private sector, and they credit the account of the seller of the bonds. So that means that the checking accounts, basically, of those people who sold the bonds to the Fed go up. That means the money supply goes up. They've got more money to spend, and M sub 2 goes up. So that kind of quantitative easing, they do it in the United States, and that's caused the money supply to increase by 37% since COVID. Okay, so that's the way they do it. Now, Europe, the European Commission, as well as the European Central Bank, they make lots of mistakes. This is a big problem in Europe, by the way. The European Central Bank doesn't really understand what it's doing. And the Bank of Japan, by the way, does exactly the same thing. They do quantitative easing, but it doesn't really increase the money supply very much. And the reason for that is that the ECB buys the government bonds and securities from the banks as opposed to the non-bank private sector. And by doing that, it's just like a swap. They buy the bonds from the banks. Okay, so the bonds go on the balance sheet, the asset side of the central bank, and what goes on the liability side? They just increase the reserves of the banking system. But if the banking system doesn't have any demand for credit or loans, they don't increase the loans, and they don't increase the money supply very much. So what happens is the banks in Europe are full of cash due to the quantitative easing that the ECB is doing. And what do? The banks do swaps out of euro into dollar, okay? So the first thing, ECB is increasing the reserves at the bank, so they have a lot of cash. The banks then do swaps out of the euro into the dollar because they can earn a little higher interest rate, okay, in dollars. So they put those reserves, actually, they park them at the Fed because they do then reverse repos with the Fed.
Yeah, they're selling euro for USD because of the carry trade.
So that to keep it simple, I don't want to get too technical here, but to keep it real simple, what's going on is that the ECB is pumping essentially a lot of euro cash into the European banks. The European banks swap that into US dollars. And then what do? then the European banks do reverse repos and actually loan those dollars to the Fed and park the reserves at the Fed. So that's why the dollar is so strong, because the whole system, the ECB is producing euros, but where do they end up? They actually end up swapped out of the euros into dollars. So so that's why the dollar is so strong against the euro right now. It's this different way they're doing quantitative easing, and I've talked to enough European central bankers. I don't think they understand what they're doing, honestly. I think there's a level of incompetence here that is quite remarkable. So if this continues, I think the dollar will stay pretty strong against the euro. If somehow they change policies, obviously these positions could be unwound and the euro could get a little stronger.
Yeah,
so
something I may.
The simplest way to go, if you don't have a strong, let's say you're a Bulgarian. I remember a Bulgarian friend of mine who works for the Sofia Opera. She asked me once, she said, Professor, this is several years ago. She said, do you have a big opinion about the dollar and the euro? Where should I be putting my money? I said, I don't have a strong opinion. And I don't. I have no position now, by the way. I'm not trading the euro or the dollar as a pair. I told her, put 50% of it in dollars and 50% in euros, and you'll be okay. So she hedged, and she's done very well, by the way.
Yeah, I can imagine. Something I may add here on top of everything you said, which I agree fully with you. It is what I call the US dollar vortex. What you mentioned is just one side of it, but the other side is that the US stock market is doing spectacularly better than the European stock market, and pension funds and all the capital is going to the US stock market for better yield. So it is buying dollars, investing. All the investors, even here in Bulgaria, are looking for US-based exchange-traded funds. And this is a big problem. So nobody is asking about European-based ETFs for the German market or the UK market, but everybody is interested to put their money into the S&P or NASDAQ. So this is also attributing to the big problem of weak euro, strong dollar, in my opinion.
Well, Miroslav, I completely agree with you. And the problem in Europe, you've got these layers of government and different sovereigns. I mean, you've got the EU on top of all these sovereign governments. You have so much government that the public sectors are. I'm very long-term pretty negative on Europe, and the reason why is that Europe never learns supply-side economics. Remember when Reagan was president, you mentioned I was one of his advisors, one of the supply-side economics kind of teams. If you want to get the growth potential of an economy up, you have to have moderate taxes and you have to have moderate rational regulations, and you don't have those in Europe. The potential is low because you've got tremendous tax burdens, because you've got these huge public sectors, and you've got a mass of regulations. If you don't, you not only have the sovereign regulations in Germany or France or Holland, wherever you happen to be, or God only knows Bulgaria, but also you've got the taxes. So with these burdens and these supply side problems, you've got inherent slow growth. That's why the growth rate, if you look over the last 10 or 15 years, the growth rate in Europe on average for the EU zone is about 1 percentage point lower than the United States. So you're just in a low growth trap. And I don't think that you're going to get out of it, because now as we go into this green madness, you're going to have so many regulations and such a mess. Look at the energy situation in Europe. You mentioned that briefly, Miroslav, but the energy prices are through the roof compared to the United States. And they're through the roof because of mismanagement. We're talking about incompetence and mismanagement. So you have a lot of politicians, think of it this way. You have a lot of politicians managing the European economy. It's kind of like a Gosplan type thing. I mean, everybody in Bulgaria, at least the older people, should know what Gosplan was and what the Soviet Union was all about. That's what you have in Europe. Now, it's a relative thing. It's bad in the United States too, by the way. What we have now is we're going in the wrong direction. But it's currencies are a relative thing. You've always got two bad things on one side or the other of the coin, but one of them's better than the other one.
Yes. When we're talking about Europe, I want to bring you to Bulgaria, in a sense, because we have a new government, a newly elected government after several unsuccessful elections, which has shown an interest to taking the step to joining the EU member area, the Eurozone, and accepting the euro as a national currency. So I wanted to ask you, because you're considered as the father of the Bulgarian currency board, implemented in '97, I wanted to ask you, what should the Bulgarian government do with the currency board? Should it be reformed? Should it be fully ditched, removed? What would you do? What would your advice to the Bulgarian government be in this situation with everything you know about the current state of affairs in the Eurozone, the European Central Bank, and the negatives that can follow after we join the Eurozone and accept the euro?
So this is let me be first make kind of a categoric statement, and that is I am totally against the Bulgarians getting rid of the currency board and formally joining the Eurozone. They are de facto part of the Eurozone anyway because of the currency board. So the lev really is a clone of the euro, and things in Bulgaria from a monetary point of view already shadow what's going on with the euro, and the system needs no repairing. It works exactly as I originally designed the thing. It's never been a problem. It's gone through all kinds of crises: the Russian ruble crisis, the commercial bank crisis, you name it, the Great Recession, all of these things. It's done very well. Now why I am against it, the primary reason is that you retain monetary sovereignty by retaining the currency board. Now that means you were talking about the euro and the dollar. What if the euro really would become really bad? You can easily change the anchor of the currency board in Bulgaria to the dollar. Well, if you're in the Eurozone, they're not going to let you out. You're trapped. You're going to have to stay in. So that's one thing. You have freedom and flexibility that is a very valuable thing. The next thing is that the hard budget constraint provided by the currency board, the fact that the currency board can't extend credit to the fiscal authorities in Bulgaria is an extremely valuable thing, because if you look at all the governments and all the politicians in Bulgaria, they all more or less have been fiscally prudent. And that's why the debt to GDP ratio in Bulgaria is the second lowest of any country in the EU. So that gets to the third point, and the key to the whole thing is corruption. Corruption, as I've always said, and I have firsthand experience observing this, is the biggest problem in Bulgaria. And it would be much bigger if you got rid of the currency board, because you would end up like Greece. And that is, the politicians would have the idea, oh, well, we don't have to worry about things. We can get a little reckless. There's what we call a moral hazard built into the Eurozone. We can spend a little more, after all, Brussels will bail us out. If we really get into trouble, Brussels will bail us out. Yes, if you entered the Eurozone, the central bank technically couldn't make loans to the fiscal authorities, the same as with the currency board. But you would have a moral hazard problem if you were in the Eurozone, because the politicians would think in the back of their mind, Brussels will bail us out. That's exactly what the Greeks thought. And you know what?
Free money.
Greeks. So the new government is illogical. It doesn't impress me at all. I think you got a bunch of young, smart guys, running around as if they know what they're doing. I think they're clueless. They're clueless because their big banner, they say we're anti-corruption, anti-corruption. If they were anti-corruption, they couldn't be pro-Euro. They say they're pro-Euro. That's pro-corruption. You're going to have more corruption.
Yeah.
Why are they so clueless? They're clueless because they have the begging bowl in Brussels. They want the money in Brussels. They are going to do whatever Brussels tells them to do. And Brussels is telling them, sending a signal that they want them to go into the Eurozone. And that's the end of the story. They have no ideas. The idea that you have a bunch of young people, reformers, and so they are just doing exactly what Brussels is telling them to do. Now, this is unfortunately, because I actually know Bulgaria pretty well, and its history I know it quite well, and they always are in that kind of subservient position.
Yeah.
And that's the political class in Bulgaria is always waiting for orders from somebody who is in charge, who is telling us what to do, and we will do what they're telling us to do. That's the Bulgarian political culture, and it has been for a long time.
Yeah. The way I see it, because I agree with all of your arguments, and the way I see it is that keeping the currency board is a call option on long volatility. If something bad happens to the Eurozone, if a systemic crisis happens, we have a way out with our own currency, keeping it with us, which is something that other countries like Greece and Portugal won't have as a way back, right?
Absolutely. Let's put it this way, in the sense that you just described it, Miroslav, it's like buying a little insurance.
Mm.
It's always good it's good to keep your options open and not, you don't want to be under the boot of Brussels any more than you already are. So it doesn't make any sense. The lev is a clone of the euro. So and by the way, looking back, I think the only institution, post-communist institution, that has worked perfectly and is a credit to Bulgaria is what? It's the currency board.
Yeah.
And they should be doing what they do in Hong Kong. They should be selling. This is a great feature. Hong Kong, the currency board was put in 1983. It's worked perfectly through all kinds of crises, by the way. And mainland China, how do they use the currency board and the Hong Kong dollar? Because the Chinese yuan is not convertible. It is not a convertible currency. You cannot freely convert yuan into US dollar and so forth in mainland China. But if you're operating in Hong Kong dollars, the Hong Kong dollar is a currency board currency. It's a clone of the US dollar. 7.8 Hong Kong gets you a US dollar free convertibility. And so the red Chinese actually use Hong Kong for a lot of their financial activity because of the currency board.
Yeah, completely agree with your Hong Kong example. I want to move gears a little bit with introducing cryptocurrency in the mix, because we've been witnessing a lot of financial engineering in the space in the last few years. There is Bitcoin, there is centralized finance, and I want to hear your take on what do you think is the value of cryptocurrencies in general and Bitcoin in specifics, and what's your take in general about this new asset class?
Okay, so Miroslav, this is a little bit complicated, because if we talk about digital currencies, shall we say, let me first say, most of what you read about cryptocurrencies and fintech is either wrong or irrelevant. It follows my 95% rule. My 95% rule for anything you read in the financial press is that 95% of it will either be wrong or irrelevant. And I think with cryptos, it probably is up like 99.9% instead of 95%. But so that's my general view. Now let's talk about one thing that is misrepresented by the whole crypto ecosystem. It's like a religious cult. I mean, you've had religious cults in Bulgaria, you know very well.
Yeah.
Who I taught various ones. That some of them are still alive and kicking, but this is a new one in finance. These are true believers in the cult, and they write a lot of nonsense. And one nonsensical thing is that, oh, this is an innovation because we're going digital. No, most of the money in the world is digital. 90% of all the money in the United States, it's digital because it's produced by commercial banks. It's not produced, dollars aren't produced by the central bank. They're produced by the commercial banks. And all these transactions in the commercial banks, they're already digitized. So somebody asked me the other day, I actually just had a long interview in the United Kingdom. Yahoo Finance interviewed me about digitization by central banks. And I said, I think this will happen. It's inevitable. And it's inevitable in part because everything is digitized already anyway. Now, how will that change a central bank? Let's go to the extreme. Let's assume we go to a cashless economy where all the central bank money is digitized, that we have no notes and coins, that they're gone. That wouldn't change anything because the liability side of the central bank wouldn't change. It would be exactly the same as it is now. The modality would be different because it would be digitized liability rather than being a paper note or a metal coin of some kind. So that's kind of one thing. So let's go to the second thing. How would you optimally, how will this evolve? You said something that was interesting. You said, well, what's the value of these cryptocurrencies? You use the word value. Well, the only thing we know objectively what the price is. I know what the price of Bitcoin. I could go to my app on my little telephone and I can tell you in a minute what it is. But the question you ask, he says, what's the value of Bitcoin? And we don't know the value. There is no economic theory that would allow us to determine the value of Bitcoin. Now, what are the two theories that we have? We have purchasing power parity theory. That won't tell us. We can't get the value of Bitcoin with purchasing power parity. And the other is interest rate parity. And we can't get the value for Bitcoin with that. So I think the fundamental value of Bitcoin itself is zero. Hmm. It's pure fiat. You can't exchange it for, theoretically, there's no redemption value. And what will happen, I think, is that eventually, and I don't know when this will happen, eventually there'll be substitutes in the cryptocurrency space that are superior to Bitcoin, and they will probably drive the value down quite low. All these cryptos, you have to remember, and this is the main point really to remember, I think, is that this is an investment conference we're addressing. And investments are one thing. Gambling is something else. Gambling and speculation is something else. That's not investing. Investing is someplace where you put money and there is some valuation process you go through to get the value of something and figure it out subjectively what you think the value of something is. And you have to compare that to the price in the market. And if your valuation is lower than the price in the market, well, you don't buy it. And if it's higher, it's a good deal. You buy it then. So you have to have a valuation model comparing it to the price. We have no valuation model for cryptos. So that puts us into a casino kind of realm of speculation. That's why I always say the cryptos are speculative assets. So again, being a classical liberal economist, I'm not going to interfere with somebody if they want to go to a casino and roll a dice, fine. But they should know before they go in, they're rolling the dice. And then I said that I know we will have more digitization. It's just inevitable that we will. I'm not necessarily against it. But what would be the ideal kind of crypto? What would drive Bitcoin out of existence immediately? It would be Hanke's cryptocurrency board. What we should have, and I've actually have draft legislation and draft law for this, we should have a cryptocurrency boards. We could have crypto gold, we could have crypto dollar, we could have crypto euro, crypto yen, and it would be set up just like the Bulgarian National Bank's currency board, only it would be crypto, and that I'm certain would drive Bitcoin to the wall.
Isn't that what stable coins, the so-called stable coins, represent?
Not really. The stable coins are really a lot of rubbish because, number one, no one can even do an audit of the stable coins. We don't know what assets they have. And you look at a lot of stable coins, they say they have good assets, but the assets they have are other cryptocurrencies. Yeah. So this is the stable coin thing. That's kind of the idea, but again, they're really frauds because they are not currency boards. And the closest one to that, Facebook, as you know, wanted to start this Libra.
Yeah.
And they actually, if you look at the white paper for that Libra, they actually mention they use the two words currency boards in there, but they never understood the basics. They spent hundreds of thousands of dollars. I don't know who was advising, probably millions of dollars. And the thing was a flop. It never got off the ground because it wasn't a currency board. If it was, it would have been fabulous.
One question that comes to mind when we talk about crypto is, would cryptocurrencies be something like a financial laboratory for financial engineering experiments wide in the public that can later be used from central bankers to plug in the current financial system so it can integrate with the system, with the new financial system of the new generation? What do you think?
Well, of course you can do this, but you can do it right now in the current financial system. This is again a lot of fake propaganda that you have all these young people who aren't integrated into the financial system and so forth, or you have Africa where they're not integrated, or Brazil. You know, you have in Brazil the amount invested in cryptocurrencies is 75% greater than the amount invested in the stock market in Sao Paulo. And they say, well, this is integrating people. This is integrating people. No, it isn't. It isn't integrating people. The only thing that keeps people out of the financial system is poverty. If you don't have any money, you don't open a bank account, so you're excluded. So what's cryptocurrency going to do about that? If you don't have any money, you're not going to be in a crypto thing.
Yeah.
So a lot of this is distortion, false advertising. We can do everything you can do with crypto in terms of financial engineering. You can do, and we've already done it in the current financial system that we have right now, Miroslav. So cryptos are actually just copying what's in the current financial system. Yeah. So there's nothing new. This idea that it's a great innovation, it's just baloney. I mean, all of this stuff is already done. They haven't invented anything. And that's why my position, and I've written about this with one of my former students, Matt Sakurki, is that if you look at cryptos, they are in effect banks, and they're doing what banks do, or brokerage houses do in the line of security. So they don't need any new regulation. We just have, in the United States, my position is we have all the regulations. whether you like the regulations or don't like the regulations, we have all of them, and they work perfectly for cryptos, just as they do for banks or brokerages or security houses or commodity exchanges or anything like that. But the cryptos are arguing, no, we're unique. We want some unique thing. No, what they want special regulation that allows them to more effectively compete with traditional banks. That's really what they want. Yeah. They want a special deal, and they're putting millions of dollars into lobbying the politicians in Washington for this. And I'm saying, no, just look at the current regulations we have. You have no problem applying them to cryptos.
Yeah, we have a saying in the fin technology sector that every fintech startup dream is to become a bank, but starts with the slogan that wants to disrupt the financial system, as we see it. Exactly. But the end goal is to become a bank, right?
Yeah, well, but that's in effect. Most of them is that, we have this saying in English, maybe you have it in Bulgarian. If it walks like a duck and quacks like a duck, it is a duck.
Yeah, yeah.
And most of these things walk and quack like banks.
Yeah, I agree. It's just new money with a different name, like tokens, right, etc. With a new game mechanics, but basically, I agree. It's a new form of money, new form of banking.
And one thing that is problematic about it at present, by the way, operating in the space or ecosystem, as they call it, that they do, is that with Bitcoin, the careful studies that have been done on this, almost 50%. There are almost no transactions in these cryptos. So they are a speculative asset. It's a greater fool's theory. I buy Bitcoin today, and because I think Miroslav's going to be a greater fool, and I can sell it to him tomorrow at a higher price. That's really what goes on. But the transactions that take place, the money laundering and illegal activities, whether they be ransomware or you name it, about 50% of the transactions are actually in these illegal activities right now. So that's really the main use for Bitcoin.
Yeah, I want to shift to another topic, because we surely got your opinion that cryptocurrencies are no inflation hedge, right? At all.
Right. It's just, again, if you want to gamble,
yeah,
and you're going to the casino, but you have to realize that a tiny percent of the cryptos are owned. I should say, let me correct myself. A tiny percent of the owners of cryptos dominate the ownership. It's very concentrated. So the whales, they call them whales.
Yeah.
The whales, these are highly manipulated markets, by the way. Highly manipulated. Because
highly liquid as well. I mean, a lot of thin order books.
So it's like a casino. The house always holds the winning hand, and the whales always hold the winning hand.
Yeah. But when we talk about inflation hedge, something people ask me a lot. Where would you put your money if you want to hedge against the coming inflation that we talk?
Let's get into the real world.
Yeah, to the physical stuff.
So remember the first thing to remember that monetary sequence that I gave earlier and talk. Money supply surges, 1 to 9 months, asset prices go up, 6 to 18 months, real activity picks up, 12 to 24 months, inflation picks up, and that's where we're at in inflation right now. So you want to be long commodities. You want to be long commodities, and right now I'm long commodity, very heavily long commodities, tilted into energy, especially natural gas and crude oil.
Are you owning them directly or through stocks, or both?
Directly. See, I'm an old commodity trader. If you think oil is going up in price, you don't buy an oil company. You buy oil. You don't buy a derivative of oil. I'm not saying always, but that's the first thing. If you have a very concrete idea about a commodity, which way it's going, and it trades in a liquid market that's easy to get into, then you go directly into that market. You don't go into a company related to it. Now, so I said oil and commodities. I said oil and gas. I also said earlier lithium. Remember I told you about lithium. Now, lithium is not in a liquid market. You can't trade lithium spodumene or carbonate. So what do? You have to find the companies that are involved somehow in the lithium supply chain. So that's what I do. So you can't really trade it directly.
What about uranium?
No, I honestly, I don't have any opinion about it. So I know it's gone up tremendously in price, but I'm not trading it. So I don't have any opinion. The second category, besides commodities, real estate. Real estate, even for the average investor, for a small person, you buy your apartment. That's an inflation hedge. Or for me, like I told you, I grew up in Iowa on the farm, and farmland in Iowa. This is the prime farmland in the world, by the way. It has gone up this year 29%. So this is a very stable investment, a very
productive one.
Very, very little, since I was a boy, it goes like this. Up, up, up. Since I was, by the way, speaking of that, I'm almost 80 years of age.
Congrats.
I'll be the 29th of December, just a few days from now, I'll be 79. The price of agricultural land in Iowa is at an 80-year high.
Wow.
So from the day I was born, it's been going up. And it's a very safe investment, but it's a very good inflation hedge. Now let's go beyond this. Let's talk about equities for a little bit, and I'll talk about only the U.S. I'm not going to get into other countries. If you look at the options market right now in late December in the United States, the options market's pricing in about an 8% increase in the S&P 500. So you mentioned Europeans and Bulgarians wanting to get into dollar-denominated assets, and so the options market looks like it's not going up as much as it's been, but 8% is 8%. It's plus. It's my rule number one: don't lose money. Rule number two: remember rule number one. That, by the way, that has to be for everybody in crypto. The crypto casino, they have to remember rule one and rule two.
Yeah. They have it backwards. They have it hold enough time, and the price will recover.
Right, and so let's get into equities. So that's what the option market's pricing in. Now, what worries me, the market's getting kind of tired. The dispersion in the market, fewer and fewer stocks are making new highs. It looks like it's a little bit tired to me, and I do think that the Fed will increase interest rates, and I also think that inflation. Remember, interest rates for long duration securities, anything over 2 years, those interest rates follow inflation. So if inflation goes up, those interest rates are eventually going up. The bond market right now is completely mispriced, totally mispriced.
Yeah.
For 12 months, if you look at the forward curve, they're pricing in about 3.5% inflation. Well, we already have 6.8%. And I told you the bathtub tells me we're going to be 6 to 9% for 2 or 3 years. So the bond market's very mispriced. They will eventually get priced right, and there'll be a big disruption, a huge train wreck in the bond market. When that happens, that will disrupt the stock market, and the multiples will come down. The multiples are very high in the stock market. They'll come down, and they'll come down most for the tech stocks, these new startups, especially new startups, because new startups have very high multiples, very high valuations. They don't earn any money, and the prospect is that, well, way out in the future, they'll start making money sometime. But that isn't very important. If you're using a discount rate that's almost zero, it doesn't make any difference. You say they get a very high multiple. Once the interest rates start going up, you will see the value. We know what the price of those companies are, but the value will come way down because the discount rate on that free cash flow that's going to come way, way out in the future will go up, and the value will go way down. So the value will collapse relative to the price, and of course the price will collapse with that. So I'd want to be short these all these new tech stocks. I'm short, and also short small caps in the United States.
Yeah. What about long-term bonds? Is this the same straight out there?
Short. There's gonna be blood on the street.
Yeah.
You want to be short those. The only bond that you should be long are inflation-linked bonds.
Yeah, tips.
Treasury inflation protected security. So those are fine because they're indexed to inflation. But any other bond, I wouldn't touch them with a 10-foot pole. They're going to be a disaster.
Yeah.
So that in summary is it. Long commodities, especially natural gas, crude oil, specialty things like lithium, companies involved with lithium or vanadium, real estate. You can even buy a little apartment, get a mortgage right now and buy it. That's what I do. Equities, as you say, I selectively, if you're in a company, for example, that's involved in lithium, you can't trade lithium directly, so you buy the company. So you're long. By the way, another group that I'm long, and I've always liked since the Great Recession, home builders in the United States. There's a big deficiency in home construction in the United States. That's kind of dovetailed into the real estate thing, you see.
Yeah.
So those are a few little spots that are okay in equities. The rest of it I'd be very cautious on, or short small caps, short the new tech companies, and that's about it. The bond market, stay away from it like the plague.
Yeah. What about the shiniest assets of all, gold? What do you think about it?
I'm still long gold and bullish on gold. It hasn't done much lately. Long term, you want a little long term gold. It's a long term, but I am bullish on gold, and not as long as I once was, but I'm still a little long.
Yeah. What about silver?
No opinion.
No opinion. Okay, but do you own physical gold or you own it through ETFs?
ETFs.
One last question I want to wrap up with is you have a new book coming up, which I think will come very handy to our new government, which has been quite a lot of interested in increasing our public debt. Could you tell more about your new book that you're a co-author of, and what is it about?
Well, yeah, the new book, which will come out in January, Lexington Press, and you have my chapter, and you have, I think, the index, but the debt and leverage are something that you should be very careful about. And I think the currency board discipline and the low debt to GDP ratio has been a very healthy thing for Bulgaria. And if you look, what country has the lowest debt to GDP ratio in the EU? Estonia. And that's where we put a currency board in 1992. And they're very disciplined in Estonia. It just gives you a lot more flexibility, and also this idea, this gets into corruption, by the way. This is the Bulgaria corruption is the main problem. Political corruption is the main problem. Any Bulgarian knows this. I've never talked to a Bulgarian who isn't aware of this. And if you have more debt, you will have more corruption, because you're going to have more government spending, more loose spending, and less discipline on the politicians. The only way to mitigate corruption and keep it slightly under control in Bulgaria, to keep it from exploding into a terrible problem, much worse than now, you have to keep politicians in Bulgaria in straitjackets. And the only way you can keep them in a straitjacket is, one, with a currency board, that's the institution, and two, that keeps the deficit under control, because they where are you going to get the money? You'd have to go to the bond market to get the money. So the only way to control politicians and to keep them halfway honest in Bulgaria is to keep fiscal discipline. And that's the main message, by the way, in this book. The main message in the book is to keep fiscal discipline, keep the politicians in some kind of orderly regime. And if you do that, you will eventually be in a position of letting the private sector flourish, letting productivity and prosperity flourish, and not having the government squeezing out the private sector. Because if you allow loose fiscal policy and building up of debt, what happens? That means it's financing government expenditures. That means the government squeezing the private sector out. And you need the private sector and innovation in some place like Bulgaria or Europe in general. It's a real problem.
Completely agree, Professor. Any last words or wisdom you want to share with our Bulgarian viewers?
Well, I really regret not being there in person with you in Sofia. As I say, this is a happy rendezvous for Mrs. Hänke and I. Is always a visit in Sofia and see our friends in Bulgaria. Yeah. So with that, let me wish you all a happy new year and a great trading day.
Thanks, Professor. You're always welcome here. You've done so much about our financial discipline that I think many people can't imagine, because they can't comprehend the opportunity cost of not having a financial discipline in this world.
Let me. I'm going to grab one thing and give you a quote on debt. Just a second. I have a little book. I just got it from my library. It's called Warren Buffett Speaks: Wit and Wisdom from the World's Greatest Investor. So as I'm reading down the index here, we talked about cryptocurrencies, and remember what I told you about Rule 1 and Rule 2. Well, I'm just looking here. He's got one section on avoid risk, and the thing right below it, don't gamble. So those are two things. Now I'm looking at I want to find, he has something about debt that I liked. Avoid excessive debt, page 108. Let's see what Warren Buffett has to say about that. Okay, here's this. This is for Bulgaria. This is for the new government. The new prime minister should read page 108 of Warren Buffett's book. Avoid excessive debt. Buffett calls borrowed money a dagger tied to a company's steering wheel, pointing straight at its heart. You will someday hit a pothole. So you've got a dagger sticking out of your steering wheel on your car, and Buffett's saying, if that's the case with a lot of debt, you're going to hit a pothole someday, and you know where the dagger's going.
Yeah, wonderful quote. I fully agree. I mean, the risk is down the line. It's so a lot of debt will.
You know very well what the politicians want to do. The politicians want to borrow a lot of money, spend now, and buy votes. That's how you buy votes, and have some other taxpayer in the future paying for the thing. When the politician's long gone, all of a sudden the bill's going to come home. The dagger is going to stick some guy in the heart because the pothole will arrive.
Yes, Professor, it was a great pleasure having you with us. I think everybody already liked what you shared with us, all your wisdom, all your 80 years of wisdom and trading experience. I wish you steady health and keep that vibrant spirit with you. We'll be glad to have you again, even on the 90th birthday or sooner in Sofia.
Miroslav, thank you very much, and again, Happy New Year.